With that, we're coming to the last part of the section where we talk about 5 examples, bad examples. I know I've been through several bad examples already, but these are just more bad examples to show you what mistakes not to make. We use the US yen on this. You can see at the top, we assume that price will break the resistance upwards. Right? You see price coming down already. At this point, you see price coming down, the one candle moving up. If you're too eager, you're saying, oh wait, it's coming down, it's going up right now, I can keep my stop loss very tight, I want to buy it up. What's going to happen is if once you buy, it shoots straight back down again. Right? This is when you don't follow the 5 steps. Trend is down, you want to assume that it's breaking upwards, you buy, everything goes against you. Indicators are all against you as well. In another scenario, this is where you ignore the risk-reward ratio or the probability of risk and the speed of reward ratio. You're looking at it and it's a hit, price is coming down, it's hit, it's bouncing off. Again, you're going counter trend. You might enter at that point or halfway through this move upwards, stop loss being very low, take profit being small. You're ignoring the risk-reward ratio, the speed of risk-reward ratio. And then ignoring indicators such as the MACD. At this point again, you say, hey, wait, it went up. It's been going up, it's breaking through resistance. I want to buy because I believe that I can enter there, stop loss below, take profit level at this point. I'll draw it now actually. Entry here, stop loss here, take profit at this point. Looks like a good trade, but look at what MACD is telling you. My sped up MACD telling you a bit ahead of time what is likely to happen. It's probably going to turn back down. So if you ignore indicators that we provide to you, you can, but it also means that most likely it's going to start coming back down again. Only using MACD is also a big problem. You can see the trend is coming down. You can say that it's moving towards the resistance level. Or every time you're answering those questions, it's only because you have seen that it is a strong move upwards. You've seen MACD cross up and you're looking through the 5 steps to give you the answers towards entering this trade. If you look to buy, because MACD is crossing up, you'll be buying at resistance. And if you buy at resistance, what's going to happen? It's going to sit at resistance for a long time before turning back down, hitting your stop loss, and possibly going back up or fluctuating in that region again. So the MACD is powerful, the MACD is good, but you should not use the MACD alone. Use it together with the 5 steps. And when you go counter trend, this is not the best example of counter trend, but look at it. As it's moving downwards inside the Bollinger 1 and 2 standard deviation, every time a white candle comes out, you might be tempted to say it's going to reverse. And you look to buy at that point, what's going to happen? It drops. White candle comes out, you look to buy again, what happens? It drops. Consecutive white candle comes out, what happens? You buy, it drops, you buy, it drops, you buy, it drops. When you stop buying, it continues, it goes up again. So when you start looking at counter trend trades, you know that it's only going to be successful 30% of the time. So be careful of counter trend trades. For now, use the 5 steps. Following trend, I've shown you 30 something trades. Following trend, making good trades, making good rewards. Do it on the trend following method first. And then if you want to, or rather you need to, scale up on your returns. If you want to go to the next level, make sure you join me on LCMS Traders Club.